In this video, we're going to talk about how homeowners can get the most deductions possible so that they can maximize their tax refund. When you're a homeowner, you want to make sure that you get every deduction possible so that you can get the maximum amount of tax refund that you are deserved. So you may be wondering how items like home improvements, mortgage insurance, and even itemized deductions may be impacting your tax bill this year. Things can get complicated, so that's why in this video we're going to go over some of the most common tax deductions that homeowners can take advantage of to reduce their tax liability. Hey, what's up guys? My name is Chase and this is a Paint Pinter's Guide, and we want to make sure that we get you the biggest tax return possible, as well as give you information about tips and tricks on how to make money, save money, and how to increase your credit. So if you're interested in stuff like that, hit that like and subscribe button and we'll jump right into this video. Alright, so the first one is going to be mortgage interest. If you are paying mortgage interest over the past year, then you can take and add up all of that over the past year, and you can actually deduct that from your total income. If you signed a mortgage on or after December 16th of 2017, then you can tax deduct your mortgage interest on loans that are up to $750,000. Now, if you signed before December 16th of 2017, then you can tax deduct your mortgage interest on loans up to $1 million. So the difference between the different dates is the Tax Cuts and Job Acts, which wasn't into effect until December 16th of 2017. So if you did have a loan before this period of time, you were grandfathered into this higher rate. And if you do own a mortgage, then your mortgage company will then send you a Form 1098 with the total of your mortgage interest, as well as how much you've paid on your mortgage so far, so that you can apply that towards your taxes. So just as mortgage interest is tax deductible, so are points that you use to lower your interest rate for your mortgage. So just like mortgage interest, where you are limited to $750,000 homes, if you did buy your home before December 16th of 2017 and your home was $1 million or less, then you can tax deduct those points that it took to lower the interest rate. There's some cool things that you can do with these tax deduction with your points. You can write it all off all at once, or you can decide to do a certain percentage of that over the time that you own the mortgage. And also of note, you can tax deduct the points for home refinance loans, but unfortunately you can't do it all at once. You have to do it over the span of the mortgage. All right, number 3 is going to be the home improvement loan interest deduction. Now, it used to be that if you were to take out a loan to improve your home, then the interest associated with that would be tax deductible, but that is not the case anymore. Nowadays, the only way that you get a tax deduction for home improvements, it has to be 2 types of improvements. One will have to be a medical necessity improvement, or the other will have to be a solar energy improvement. On the medical side of things, this would have to be something like a wheelchair ramp or a specific toilet or something that have to do with the shower that will help you ease in and out on a medical necessity. And as far as for the solar side of things, this would have to be a solar panel that is installed, and you can tax right off that. And for where I live, for these solar installations, you can tax write off up to 26% of how much it costs to install this, and over the longevity of time, you can then save some money. All right, number 4 is going to be property taxes. You can tax deduct up to $10,000 in property taxes, and that includes state and federal. Now, that is specifically for married and filing jointly. If you're married and filing separately, or just if you're an individual, then you can tax deduct up to $5,000. Now, something to keep in mind that if you do have a mortgage with an escrow, then your particular property taxes will then be applied in your annual escrow statement. Now, keep in mind that this does not count for any transfer taxes on the home of sale or any HOA assessments or anything else that may have come along with it with the payments of the loan. Now, I know we talked about earlier how you cannot tax deduct for home improvement loans interest, but you can actually get a tax deduction for a home equity line of credit that is then used for renovations for your home. Now, one thing of note is that you have to use the money that you pulled out from the particular home to then renovate the house that you took it from. For example, you cannot take a home equity line of credit from one home and then apply it to another home for renovations and then tax deduct that. Now, you also cannot take a home equity line of credit and then use it as an emergency fund and then try to tax deduct that interest. You really can't do anything with it unless you're going to be, putting it back into the home that you took it out of to be able to do the tax deduction associated with it. Now, one thing I do want to note is that just like we talked about earlier, the Tax Cuts and Job Acts, it did make a change to these deductions. It is always changing every year, and so you should keep an eye out on any new deductions that you may be able to apply as a homeowner. I would recommend trying to find a professional out there that is staying up to date on these rules specific to your location and your area, so that you can continue to get the highest amount of deductions possible and continue to, save a lot of the money, the hard-earned money that you own, and only give Uncle Sam the amount that he actually deserves. Hope you got some good information from this video. These were the top 5 tax breaks for homeowners that you can utilize to reduce your tax burden and keep a little bit more money in your pocket. Just as always, I want to remind you that we are here from your first penny to your first million. We'll see you in the next video.